Michelle, let me just begin with you. Do you think that quantitative tightening, that the balance sheet shrinking, do you think that matters?
I'm surprised by the focus that the balance sheet is getting. The Fed has obviously been in the process of normalizing the balance sheet. I think arguably we may be getting closer to beginning to think about the end of the balance sheet normalization. Maybe there's some disappointment that it's going to continue through 2019, whereas some people thought maybe the balance sheet would be left larger and the normalization would conclude ultimately sooner. But I don't see that as posing a threat to the U.S. economy. I don't think that's what's behind the weakness in equity markets, the removal of liquidity from the system. I'm as curious as anybody else about the fact that that's being given as a reason for some of the negative reaction.
Yeah, Michelle, not so much as a reason, but I think investors are confused because they say, if the Fed is tightening, it's doing it in two ways right now. It's raising interest rates, but arguably it's also, draining the balance sheet. So they're just trying to figure out, is this two-pronged tightening still happening? Or do you just look at it as having one prong like the Fed and say, Powell yesterday even alluded to something like, the balance sheet is not a monetary policy tool. We only think interest rate hikes are. Do you agree with that?
Well, I do believe that there is, to some extent, the normalization is another level of policy accommodation or the removal of accommodation. So I do think that it's fair to think of two levers. But again, in both cases, particularly when you think about interest rate increases, we're talking about normalizing. We are not talking about lifting rates or taking policy into restrictive territory. And that's the confusion here. I think the Fed, doesn't maybe do the job it needs to do, as well as talking about the fact that neither of these two actions are really necessarily doing anything to slow the economy down. It's really just removing the support that arguably an economy that's growing better than 3% for a third straight quarter no longer needs.
All right. Well, with all that said, Dan, you've been bearish stocks. Are you more bearish, less bearish, based on what Jerome Powell said yesterday?
Yeah, frankly, it'd be impossible for me to disagree more with what's being said. I don't know how frank I can be, so I'll tone it down a little bit. I think the reason that the market's selling off so much on this is because market's finally realizing that Powell is not any different than the last three Fed chairmen. They're still looking at dot plots and models and this and that, and there's no common sense. And the best indicator for what the economy is going to do is the stock market. That's really it. And when I hear this talk about, well, Powell or, whoever's running the show, when I hear this talk that, well, they're not really looking at the market, blah, 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 they should be looking at the market. They should be looking at the market. So the way I see it is, and I know I've given a couple charts to you there, on the Fed funds rate, they kept the money supply basically for free for 7 years. And I hear this talk about, well, they're normalizing and this and that. After 7 years of free money, what exactly is normal? And we're letting the same people who gave us this crack cocaine for free, we're letting them tell us now what's normal. And so I really just kind of think the market's a little bit freaked out by everything. So that's an issue.
How much damage do you see being done on the S&P 500 right now?
Well, yeah, that's a good question, Melissa. It's funny. A week ago, I had a chart printed out where when they broke the 2,600, I thought, that's a head and shoulder pattern. I'd look for at least 2,300. Now we're down 150 points, and that didn't even look like much of a call. So I will say this. Yeah, I think we could at least go to 2,300. And if you look at a longer-term chart, though, and this is kind of the silver lining, I guess, we're in a secular bull market, and it's really, really easy as traders to really zoom in, and pretty soon, you're looking at a tick chart or a 1-minute chart, and it's important to kind of step back, look at the big picture. We could actually go down to 2150 and really still be okay with respect to the secular bull market. But my question to viewers is, do you kind of want to stick around and ride that all the way down, or do you want to respect the risk that's in the market right now versus the risk of missing out on upside? And I don't think there's much risk in missing out on
Dan,
upside.
last hour we had Jeremy Siegel on, who in a way, kind of made the same point. He said that long-term investors don't need to worry, and you're also still saying we're in a bull market. So sure, it doesn't feel good to ride that down, but unless people are trying to market time at home, can't you just say, well, in the long run, you're still telling me that it's a bull market?
Yeah, no, that's a really good question, too. It's not really a function of timing the market. It's a function of managing risk. And there's a difference between timing the market and managing the risk. And what I'm saying is, with so much overhead supply, I just think there's a risk of any rally. And I think we could go back, by the way, to 2,600 on a snapback rally. I think we could. But that's really the upside that I see. And so if you're sitting there and you're a long-term investor, sure, just stick with what you got, you're good. But don't look at the market for about a year. But if you're, I mean, seriously, you know, but if you're a short-term investor, and frankly, most of the viewers are, let's face it, most of them are. It's not a function of timing. It's a function of saying, okay, the market's going lower. If I'm on the sidelines, I'm looking for opportunity.
Sure.
But if I'm in the market, I'm looking for relief. There's a huge difference between the two. So if you have a good cash allocation, now you're in prime position. You wait for this thing to settle out. But I don't think we're done. I think it's still going to be volatile, is what I'm saying.
I want to bring Michelle back in for the last word here. We've been talking about the markets. We've been talking about levels. Michelle, should the Fed ultimately listen to the markets more? Professor Siegel said that. Ed Lazier has. I mean, a number of voices have said that. The market is the best forward-looking indicator out there. And yet that is not a data point officially that the Fed looks at in its mandate.
It should be.
I think that there is a lot of information to be gleaned from the markets. Absolutely. Millions of profit maximizing investors out there tend to get the story right a lot better than us economists. I will give you that. However, I think you also have to look at both sides of this. When the equity market was running up and financial conditions were off the charts over the last couple of years, we did not see the Fed say, oh my, look at the blow-off conditions that the equity market is signaling. We can't just go gradually. We need to step up the pace. I mean, if they were truly looking at the markets, in the last couple of years, they would not have only increased once a quarter, even though they were well behind the curve. So there's a little bit of a two-way thing here. You know, be careful what you wish for. If the Fed is really going to be looking at the markets, who are looking at the Fed and looking at the markets, you know, it's not, it can get, you know, it's a difficult situation. And again, it's just not as clear-cut as it seems like now, where,
but the Fed should be looking at the market. They should be looking at the market on the way up.